So 2004, my dad came to Nashville. He bought his first property, which was a 7,200 square foot retail building on Dickerson Pike. At this time, it was in East Nashville. East Nashville was a very not the best market to be in. The neighborhood was not safe at all. There were many times where we dealt with a lot of issues. He started picking up small properties, small homes, single family homes out in that area. I remember nights where my dad or my uncle would have to actually go sleep in the house to make sure that the HVAC units didn't get stolen again. As you guys know, HVAC units are very expensive. Most of my dad's partners thought he was crazy for getting into real estate. One cab around the time when we moved over here, each medallion was worth around $80,000 to $90,000, and he was bringing in about $2,000 per month from each cab. He sold a couple of those cabs in order to reinvest into real estate. He, of course, had no prior knowledge, no type of experience. He was a rookie at that time and was making those rookie mistakes. As you guys know, and what I say in business is when you lose money, it's not really a loss, but it's the cost to learn that lesson. And for him, some of those lessons were $50,000, $60,000, $20,000. It adds on. But of course, my dad never gave up. My dad continued on with his vision, and he honestly decided that real estate was going to be it for him permanently, had no more focus on the taxi business in Seattle, and started to liquidate some of his assets. Around 2008, you guys know about the housing market crashing. That time was obviously the opportunity time for many investors. Folks that have cash had the opportunity that many folks didn't have at that time. And fortunately, my dad was able to liquidate some of his assets in Seattle and start reinvesting into the properties in Nashville. We were purchasing from foreclosures. My dad was very engaged with folks in the area, knew many property owners, was communicating with other investors. And we decided to just go ahead and continue purchasing, even though we knew it was a rough time. We didn't know exactly which direction the market was going to go in. But the risk that we took was one that many people wouldn't take, especially with the value of those cabs. I remember in 2011, some of his partners were selling their cabs for around $250,000. Now, this is right before Uber and Lyft took off. Once Uber and Lyft took off, we took the biggest hit in the taxi industry. If you guys know, the taxi industry is primarily immigrant ran. It's an industry that's not really it's looked down upon in a way. It's not the best business to be in. And it's really not. I mean, there was a lot of, first off, it's a dangerous job being a cab driver. You're at risk of getting robbed all the time. My dad has been in many situations like that, in the early 90s in Seattle, in a big city like that. But at the end of the day, most of those immigrants don't have any other means to bring food, back home to their kids and their families. So they took that risk, and the money that they were making was pretty good. But I would say in 2012, when Uber definitely took that big surge and they were succeeding all over the States, we lost close to $2 million in unrealized gains. Now, it's not $2 million out of our pocket. You guys got to remember most of the taxis that my dad bought were in the 90s. But if he had sold them, it's kind of like stocks. You buy your stocks, you see it's going up, and what's the key is to buy low and sell high. But some folks don't realize that, and it's still true till this day in any investment, including real estate. Sometimes properties are appreciating, and you have sellers that don't have a realistic expectation as far as what their property is really worth, and also if they did realize those gains, what they could do with those reinvestments. There are many lessons that I learned watching my dad build this business. It's very interesting because my dad doesn't have any type of technical skills. He doesn't really know how to use a computer very well. I still have to tell him to close his iPhone because he's going to butt dial somebody if he puts it in his pocket. So as you guys know, he didn't have the fancy tools that a lot of investors have today. He doesn't have a fancy CRM. He doesn't have a virtual assistant. It was pure hard work. I went to MOK. If you guys know, it's a magnet school in town. I was very blessed to get into that school. I grew up in Antioch, Tennessee. If I had stayed and went to public school out there, who knows what my education would have been like. But my parents, they worked hard and they made sure that I got into a decent school. And another thing that I noticed was we definitely lived below our means. I'm telling you guys this because you guys know that my dad is making all this income and he's buying properties. And of course, though that income can support any lifestyle he wants as long as he's working for it, why not? But he really showed us growing up that it's not about how much you make, it's about how much you save. Back to school shopping was not a favorite time for me. Kids were getting their fancy Jordans and Nikes, and I was forced to go to Ross or TJ Maxx to get my back to school outfit. For me, at that time as a kid, you're 12 and 13 years old, you're thinking, why can't I have the freshest outfit going to school? But of course, my dad was teaching me another lesson. And that lesson was limit your expenses and increase your income. And it was a very valuable lesson because I still carry that lesson on till today. So growing through high school was very interesting. I was also helping him type up eviction notices at 14 and doing some very basic admin work, some leases and that kind of stuff. But I wasn't really fully involved in the business at that time. By the time I graduated, I decided to go to college. I attended the Tennessee Technological University out in Cookeville. I was studying mechanical engineering. And at this time, the only reason I really wanted to go to college was to really make my parents happy. If you guys don't know, the biggest immigrant dream, and I'm sure any parent's dream, is for their child to really have a solid education. I'm sure today many parents are saying, okay, you know what, maybe going to college is not the best idea. But back then, for my dad, who didn't have the ability to even go to high school, for him, a college education was by all means the very best form of success, since he never had that opportunity. And while I was going to college, I was studying mechanical engineering, but 3 years into my 5-year program, I just wasn't happy. I couldn't really see myself sitting in an office looking over blueprints and that kind of stuff. It's not that I wasn't passing my classes, it's that I wasn't in it. And to succeed, you have to really be in it. For my dad, his work is his life. He is, by definition, a workaholic. He works 7 days a week. He's currently in Memphis right now, looking at properties, seeing what else we can buy. He does not stop. His energy is the energy that many entrepreneurs wish they had. It's something that I wish I had. It's something that I don't know if I'll ever be able to accumulate or accomplish by any means, because the challenges that he had growing up, many of us didn't have. And when you're not under pressure, you really can't. It's something you have to go through it in order for you to really to come about that. And it's just amazing. So 2013, as you guys know, the market's picking back up. We're losing plenty of money out in Seattle. My dad's no longer involved in the taxi business. I think by that time, he's only owned about 5 or 6 cabs. They were bringing in decent income, but the income was slowly dropping as Lyft and Uber was picking up real quick. We decided that we just wanted to continue purchasing. So we bought several properties in Nashville. The biggest key to our business was self-management and maintenance. That is one thing that I noticed that is something that's different that my dad does, that a lot of investors are not really engaged on that level. Many investors like to kind of, they don't want to self-manage because obviously self-managing requires time, and you could be finding other deals with that time. So there's a lot of pros and cons to self-managing. But one of the pros was there's no one that's going to take care of your business like you. My dad did hire a property manager the first time he bought a property. The second property he bought was a 28-unit multifamily building over on Jefferson Street. That property at the time was about 50% occupied, and 25% was on Section 8. There was lots of drug activity, lots of solicitation. It was not the best property to be in, especially for someone that doesn't really know how to maintain a property. It really took a lot of blood, sweat, and tears to keep that alive. But I remember my dad, he's on call 24/7. Anything happens, he has to leave. 10 o'clock at night, you have a leaking, water heater, busted water heater, or something goes bad. He's up out of that house. He's not calling, Joe the plumber, because Joe the plumber is going to charge him, $400, $500 at a minimum to fix whatever the issue is. And he knows that can easily eat into his margins. So he taught me how to self-manage properly, self-manage from a maintenance perspective. And what I did was I brought technology to our business. Since he didn't have that end, I built a system that allows us to not fully automate, but automate our business to an extent. Most of our business was pretty much cash before I took over. So on the 5th day of the month, we're literally knocking on doors, getting money orders. And my dad was walking home with a big wad of cash, which of course, 1, it wasn't safe. And 2, it's an accounting nightmare, right? You don't know where that money's going. You don't know where that money's. It's very difficult for you to really track everything. So once we built the system and we kind of automized everything and everything was digitized, our tenants that didn't have bank accounts, which a lot of them don't, we created a system for them to go and pay at different locations through the property management software. And then folks that did have bank accounts, they could pay directly from their account. It was free, and everything was pretty much great. After we installed this property management system, and it made our job a lot easier, we started going to different submarkets to figure out, because you guys know that Nashville has now taken off. We honestly didn't see Nashville take off to this level. We thought that Nashville would be a great market to be in long term. We thought it was a great city to raise a family in, but we honestly did not see the big boom happen. And this is the it city. There's really no answer as to why Nashville has become what it is today, but it being that it city. And my dad had a vision, and his vision was either Dallas or Nashville, and surprisingly, both of those cities became very great markets to be in for real estate. So that was on that end. For the most part, Nashville became great. We started losing opportunities. More cash investors came into the market. You have different hedge funds that are now in the market. So we can't really compete with those big boys, because we're not big boys. We're still the small, family-ran business trying to make ends meet. And we decided to go ahead and start traveling to Memphis and Chattanooga. I was leaning more towards Chattanooga because I thought it was a market that would probably appreciate a little bit better. At the time we went to Memphis, it was about 2017. We weren't seeing any type of appreciation. I was studying the market, and I think Memphis probably didn't see any appreciation for the last decade. This was in 2017, 2016, except there are certain parts of the city that did. But my dad knew that Memphis was going to be a great city for us long term. But one thing that I did agree with was that it was a great city for cash flow, which meant that we can go over there and there would be a plethora of tenants. It's primarily, I would say, non-owner occupied properties, which basically meant that the owner of the property didn't live in the house. Many renters, they may not be the most qualified, but since we're investors that like to get down and dirty, we're always playing in the dirt. We're purchasing C-class properties. We're in neighborhoods that most people don't want to be in. It was okay for us. And my dad was saying, all right, let's go ahead. We travel back and forth once a week. We're going to Memphis, stay there a few days. We bought a house that we also fixed, did a little house hacking, which basically meant that we were fixing the house while we were staying in it. And we also bought other properties at the same time. We tried to avoid war zones and areas that we felt like our safety was going to be at risk, because there's no profit that's worth your health, right? So that's one thing that we made very clear, is that we wanted to invest along the path of development in areas that we thought would appreciate over the long run.